Hello and welcome to Retire Rich, Tales of Financial Freedom podcast with your host, Carlos Lopez. I'm your producer, RJ Malik. And Carlos, good to see you. We haven't spoken in a couple of podcasts, so it's good to have you back. How are you doing?
I'm doing well. Thank you.
Excellent. I see you have a guest today, so I'm going to just sort of back off and let you two go. So why don't you introduce your guest and we'll go from here.
My guest is Steve Loving of Simplicity, and I work with Steve on almost a daily basis. Wouldn't you say, Steve?
Yes, I would.
He's the expert, the guru for life insurance. He's got a lot of experience. And I'm going to kind of give the floor to Steve so he can kind of introduce himself and tell you a little backstory about who he is and how long he's been in the business and how the business of life insurance has changed. Steve?
Great. Thank you, Carlos and RJ, for having me today. Yes, I do work with Carlos and a number of different advisors. I am an advisor development consultant with Simplicity and Marc, and I really specialize in the area of life insurance, asset-based long-term care, traditional long-term care, and disability insurance. And being with Simplicity as a part of Marc, they've done over $420 million of life insurance sales in the past year, $10 billion in annuity sales, and we work with 40 different plus insurance carriers for the life insurance side. Personally, I've grown up and lived in Kansas most of my life. I went to the University of Kansas and started in the financial services business right after that. I was with New York Life as a career agent for 22 plus years. And then I was an independent agent for 3 years. And then I was approached to join a company to work with advisors like Carlos and help them with their solutions for their life insurance, asset-based long-term care, and disability solutions for their clients.
Very cool, Steve. One of the things that you and I discuss a lot of times is when I have clients that I go meet out in the field, a lot of them are kind of concerned, or they're not really knowing the mechanics of the differences between life insurance. They think that all life insurance is term life insurance, and that's really not the case. Can you kind of elaborate on the different variations of life insurance that are out there for them?
Absolutely. Over the years, back some time ago, people used to think of life insurance as two forms, really, term and say whole life insurance. And there's been a number of variations in the product offerings since that time. With term insurance, it is for a temporary need where you do have whole life, index universal life, guaranteed universal life, that is for a more permanent need. And so the product span has really changed over the number of years, as well as having a number of different riders that can be attached to those contracts. And we're seeing people utilize life insurance in a number of different ways, really. Some of the things, again, people think about life insurance just being a tax-free death benefit, and it's much more than that now. There's many living benefits available to clients as well. Mm-hmm. A lot of it can be focused around supplementing their income with tax-free distributions from life insurance policies, and that can work with their income coming from, say, taxable accounts, that being IRAs, 401ks, et cetera. Also, Social Security can be potentially taxable too. So people are looking for a stream of non-taxable income that they can work together with their advisor to form that income stream in their retirement years.
You mentioned something about long-term care or different riders that are out there. How does that work within the life insurance policy once they sign up?
Sure. With long-term care, and again, there's long-term care riders, chronic illness riders, mm-hmm. terminal insurance riders, and then even child insurance riders too. But with the long-term care, you can add a long-term care rider to a permanent policy, and then benefits coming out of that contract for a long-term care need would be tax-free as well.
That's right. And one of the things that we also see from people that are watching TikTok videos or getting informed on certain policies are, can I insure or start something for my child or my baby to give them a head start so they can build their wealth and have something by the time they're in their 20s, as opposed to a college 529 plan. Is that something that, I mean, how much of that have we seen, or how much of that have you seen with the other advisors that come to you with policies that they need to be, they need to be processed?
Sure. As you and I've seen, Carlos, I mean, when you're talking with clients, we are insuring the parents properly, and then they really like what we are showing them for their benefit, but they're like, boy, I wish I would have started this sooner. And
Exactly.
so then we do bring up a possibility for the kids to be insured. The parents pay the premiums, and starting that child on a early path for a savings plan with life insurance as a wrapper around it. And that policy could be used for a number of different things. It could be used for a first-time home purchase, for higher education expenses, unexpected events that might pop up, or even opportunities too. So yes, we are designing a number of different plans for younger children of parents, and it could even be grandchildren too, to give them that head start with some proper planning. We like to think of life insurance as one of the pieces of a solid foundation of a solid financial plan.
Exactly. And sometimes parents ask me and clients ask me, well, how do these policies earn interest? And there's participation rates. There's different the floors. There's a floor characteristic or feature of a lot of these policies. Can you explain those to us?
Yes, a little bit. We could certainly touch on that. And with the Index Universal Life, there really is a 0% floor protecting about from the performance of that contract. So if a policy does a negative return, that client would receive a 0% return for that year. And so clients really like that. The participation rates is an expansion of the actual return of the indices, underlying indices. And so with that, it can be a multiple of what the actual return was in the indices. So yes, there's a number of different features that can make it really ideal and appealing to a number of clients. Again, protection when the performance is negative, enhanced growth potential depending on the strategy, when the contract is in a positive status as well.
Yes, and we're talking mostly for the audience that's watching this. This is mostly for Index Universal Life Insurance. And there's also features where a client can, in the future, once the cash accumulation has grown so much, that they can actually take a loan against the policy, the cash value, without having to pay any, I don't want to say penalties, but what would you say?
Yeah, absolutely. And with that the client can access the monies in that contract anytime prior to 59.5 without a penalty, and even beyond age 59.5. And so, yes, they can take withdrawals from that contract without any penalties whatsoever. It is in a preferred loan rate as well when they do take that out as a loan or a withdrawal. And it really just gives them that flexibility to utilize that policy as they see fit. Again, it could be to supplement retirement income, opportunities or emergencies that come about. And with the Index Universal Life too, you do have flexible premium payments and adjustable death benefit too. So as things change going forward, if they want to put more money into the policy, we can test it and make sure that it is acceptable to do so. But yes, there is modifications to the policy that makes it very flexible. And again, people find that pretty appealing. Okay,
so the Index Universal Life Insurance policies are flexible. And they have death benefits. They have riders that they can be attached to them. Tax deferred growth. What else do they have? The participation rates have been raised usually on most of these policies. So if a person makes 5% in a financial instrument, let's just say 5%, and they're participating at 100%, then they make 5%. But what if the policy has participation rates of over 200 or 300%? Well, the interest that they earn in them would be double or triple. Correct. So the cash accumulation within that policy would grow a lot faster than otherwise at 100%.
Very true. And with that 0% floor too, that provides a lot of protection for people.
Okay. So the final question I have, Steve, is who are these policies, or these Index Universal Life Insurance policies? Who are they suitable for?
Sure. I think we kind of touched on that as well. I mean, certainly people in their earning years and children of the clients themselves. And then we are also seeing it for couples that might have a joint index universal life contract and they're wanting to set that up for a future death benefit that would be payable on the second passing of that second spouse. So it could be used in a number of different ways, Carlos. I do believe with all life insurance, it makes sense to maybe start something while you're young to ensure your insurability and then take advantage of the compounding that can take place of the monies within that policy.
Well, clients also ask, Steve, it's interesting. They also say, can I do a part term insurance and part index universal life?
Absolutely. And I think that's a good idea too, because you may not satisfy all your life insurance needs with a permanent policy. You might have some temporary needs. So why not layer in some term that's relatively inexpensive that gives you a lot of coverage for the dollar? And with that, in combination with a permanent policy, you've got a pretty sound insurance plan in place.
And when parents start off an index universal life insurance policy for their children, their child or children, they're the owners of the policy, correct?
That would be correct. And that would usually be the case until age of majority or whenever that parent feels like it's feasible to have the sole owner as that child.
How often should you check your policy? And this is sort of selfish because I got a policy about 12 years ago, and I haven't looked at it since. I'm gathering after listening to both of you that that's probably a mistake on my part.
I would recommend, and Carlos probably would too, is just to have a review with your planner, your financial planner once every year, just to touch base and to review and make sure that policy, as well as all your other planning, is in line with your goals and objectives, really. A lot of things change, as you know, pretty quickly in life. And so it does make sense to review that and also reviewing your beneficiaries too, to make sure that those are up to date, because that's pretty powerful. Typically, an insurance company is going to pay to that written beneficiary. And so keeping those up to date is very important.
Okay, very good. Carlos, back to you.
Oh, Steve, you've been great. I just wanted to know if there's any last notes or last things to address for this podcast for our audience.
I was just going to say that a lot of people do rely upon group life insurance too. So I think it's really important to have some life insurance that you're in control of, no matter what happens with your job or employment, that you always have that amount of insurance, because the group insurance can kind of come and go. But if you have individual life insurance that you own, you're much more in control. And it's just a great foundation for a good financial plan. And I'm sure Carlos would be happy to help you with that.
Fantastic. Steve, how can people get in touch with you?
You could reach me at my direct phone. That would be 713-808-8543. Again, 713-808-8543. But certainly questions from clients, I would refer them to Carlos. If an advisor wanted to get in touch with me, I'd be happy to visit with them as well.
All right, Carlos, and your contact information.
956-994-0407.
Excellent. Is there anything else you want to add, Carlos?
That's it. No, we're
okay,
good.
Very good. Steve, thank you very much. And thank you for listening to today's podcast. Looking forward to your next podcast, Carlos. And thank you for listening again to Retire Rich, Tales of Financial Freedom podcast. Please like, follow, and share this podcast with your friends and family. Until next time, for Steve and Carlos, I'm R.J. Malik.
Thank you for listening to Retire Rich, Tales of Financial Freedom. Have questions about topics covered during the show? Visit our website at www.mahfinancial.biz or give us a call at 956-994-0407. Don't forget to click the follow button to be notified when new episodes become available. Investment advisory services and financial planning services are offered through Simplicity Wealth, LLC, an SEC-registered investment advisor. SEC registration does not constitute an endorsement of the firm, nor does it indicate that the advisor has attained a particular level of skill or ability. Insurance, consulting, and education services offered through M.A.H. Financial. M.A.H. Financial is an unaffiliated entity from Simplicity Wealth. Clicking the like button does not constitute a testimonial for or an endorsement of our investment advisory firm, any associated person, or our services. Clicking the like button is merely a mechanism to circulate our page. Like is not meant in the traditional sense. In addition, postings to our page must refrain from recommending us or providing testimonials for our investment advisory firm. Because the SEC and state securities regulators generally prohibit testimonials, any such postings are subject to swift removal.
The views expressed herein reflect the views of Marc Hernandez and Carlos Lopez as of the date referenced. These views may change as conditions change. The views expressed herein are not intended and should not be construed as investment advice, and they do not address any individual's specific situation.